Hello, everybody. In this moment, we are talking about current assets. Each business year, companies must keep and submit many different financial documents that explain and show everything income to debt. One of those documents is called a balance sheet. A balance sheet shows what companies have, what they owe, and their ending balance for them. One of the main things contained on a balance sheet is current assets. And then we move to types of current assets. The first type, cash and cash equivalents. Cash is simple. It is how much money you have in the bank. Cash equivalents, meanwhile, are things that can easily be converted into cash, like short term savings bonds, short term investments, and foreign currency. And then the second, other liquid assets. This is the catch call category. If you have any other current assets that can easily be converted into cash within a year, like promissory notes or tax refunds. And then the third, marketable securities. Marketable securities are investments that can be readily converted into cash and traded on public exchanges. This applies to cryptocurrency, for example, and other more standard marketable securities and short term investments that are easy to sell. And then, fourth, prepaid expenses. Prepaid expenses include everything you've paid for but expect to benefit from over time. If you're paid for a year long lease or can an extended insurance policy, you have prepaid expenses. Report there on your company's income statement over the period the payment covers. And then fifth, accounts receivable. Any of your business outstanding debts are considered accounts receivable. It is the money that clients or customers still owe you for services already rendered or goods already delivered. And then six, inventory. Inventory covers the products you sell and is listed on your balance sheet as finished goods, works in progress, raw materials, and suppliers. However, not all inventory counts as a current asset. Any inventory you think you'll be holding on to for more than a year should be considered a non-current asset and listed as such. And then seventh, suppliers. Suppliers are tricky because they're only considered current assets until their use, at which point they become on expense. If you and your company has a stock of unused supplies, list them under current assets on your balance sheet. And then how to calculate current assets. When you have access to a company's financial statements, there is no need to calculate current assets because the line item is clearly shown on the balance sheet. Alternatively, current assets can be calculated in one of two ways depending on what information you have access to. The first, add up all of the liquid assets of a company. And the second, deduct a company's non-current assets from the total value of its assets. According to the accounting equation, assets are equal to liabilities plus equity. And then, what can you do with current assets? Maintaining a robust level of current assets is essential for the sustainable operation of the business. Current assets provide the financial flexibility to meet immediate and short-term obligations, ensuring uninterrupted business continuity. These assets can be utilized to fund various business activities, including the first daily operation, inventory, payroll, and other ongoing expenses. And then we move to second, debt servicing, payment of bills, loans, and other financial obligations. Third, growth investments, equipment upgrades, expansion of facilities, and other capital expenditures. And then we move to key characteristics of current assets. The first, current assets are often tangible, physical things that are expected to be used or converted to cash within a year. And then the second, they are not subject to depreciation. And third, they provide financial benefit to the business by allowing it to cover day-to-day expenses through their sale or use. And then the advantages of current assets. The first, liquidity and cash flow support. Due to other fluid nature, current assets significantly contribute to positive cash flow. This capability allows companies to manage day-to-day operations, covering expenses like payroll and raw materials purchases without depending on long-term or external financing. And then the second, better risk management. Current assets act as a financial buffer, providing a safety net so that companies can navigate economic downturns, industry challenges, and unforeseen circumstances. And then third, credibility with creditors and investors. Holding a healthy current asset position represents a business strong cash flow, ability to fulfill short-term financial needs, position to grow, and creditworthiness to both lenders and investors. And fourth, operational efficiency. timely collection of receivables and effective management of the current assets ensure a steady stream of cash to support ongoing operation. Sufficient cash is necessary for purchasing essential inventory, sustaining production, etc. I think it is enough of this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.